Yes, like. Yeah, so it's welcome to the participants and the guests who have already joined the today's wonderful session to be conducted by the Consulting Engineering Association of India. And in very shortly, we will be starting off at 4 p.m. We have a significant amount of participants, and I think we will wait for the full house. And in about 5 minutes, we should be joining and starting the wonderful session today. We are already at 4 p.m. So with the kind permission of everybody, should we start, sir? Okay. So warm welcome to everybody and the audience. We have a very illustrious speakers and eminent personalities to be here today to share the knowledge on the project financing, which is one of the most important subjects in the Indian context. And before I do so, I will like to introduce the Consulting Engineering Association of India, which has organized this free webinar for the professionals, members of CEI, as well as beyond that, to significant amount of time. And the CEI genesis goes back in 1959, where it was set up as Association of Consulting Engineers of India, as ACE, and thereafter the merger, along with the National Association of Consulting Engineers, which was also formed in 1976. This association has formed in 1996. It has offices at the headquarters at Vasant Kunj in Delhi, and regional centers in Bombay, in Jaipur, in Delhi, and also in Kolkata, and also in southern part in Hyderabad. It's the only consulting organization which is affiliated to the International Federation of Consulting Engineers, that is FIDIC, in Geneva. And CEI is also the founder member of the Engineering Council of India, which is formed by the 24 professional organizations. Its aims and objective is to promote the professional interest and establish rights and privileges of consulting engineering profession in India. It is also there to disseminate, like today we are disseminating the information on technical subjects, essentially, to promote adoption of equitable forms of contracts and encouragement settlement of disputes by conciliation and mediation and arbitration process also. There are several stages and categories of members: honorary fellow, the life members, individual members, affiliate members, young professionals, and we encourage young professionals to come and join this entire organization. There are many organization institutional members like EPC organization, etc. Some of the prominent members who have been there are Mecon, RITES, the Tata Consulting Engineers, the WAPCOS, the AECOM, the RVs, L&Ts, the Mott MacDonald, SMAC, and Development Consultants, L&T, etc. CEI also publishes different publications, and only authorized agency to also publish and distribute the FIDIC, the publications across the world, across into India. Of late, it has been playing a very stellar role in many important areas, especially highways, power, and multiple areas, and also in the river rejuvenation, etc. So with these few words, I have the brief introduction of our eminent personalities today. First of all, Mr. Yaduvendra Mathur, who would be providing some deep insights and brief introduction about the subject of the project finance. Shri Mathur is an IAS of 1986 batch of Rajasthan cadre, and he retired as the Secretary to the Government of India in the Niti Aayog, heading the National Infrastructure, the Project Appraisal Division. And he had one of the splendid, innings as a CMD of Exim Bank from 2014 to 2019, and also has been on the board of directors of African Development Bank, and also the CMD of the Dedicated Freight Dedicated Freight Corporation of India, and also the CMD of the state power utilities in Rajasthan, vast experience in the project planning and execution. So with these few words, I request Sri Mathur to kindly give a focused discussion and focus points and brief introduction to the vast area of project finance, especially in the Indian context. Over to Sri Mathur.
Thank you, Mr. Das Patnaik, and good afternoon, all distinguished delegates participating in the CEAI Eastern and Northeastern region chapter, which is headed by very distinguished Mr. Saurabh Das Patnaik, very active. Thank you, Mr. Patnaik, and congratulations for hosting this event. And on behalf of all of us from the Consulting Engineering Fraternity, we really want to acknowledge your leadership. The theme that has been selected for the webinar, project financing, I know we have a very distinguished speaker presenter in Mr. Shubhendu Moitra, who would walk us through what exactly a project means, project financing, how is it different from what we conventionally understand as capital expenditure financing or business financing. So I think we will go through that, which is very, very critical. I recall many years ago, decades ago, this whole issue of how is a project finance different from other traditional ways of financing was unfortunately not understood. When I joined service in 86, and even before that, I was working with Larsen & Toubro and then with ACC. Even at that time, and I'd done an MBA. But unfortunately, the sharp focus on what is project financing was not really seen. We had read it theoretically. We knew a little concept, but in the real world, how is project financing? What is going on in this whole developmental impact that we know that comes from financing of particularly infrastructure, but project financing can be executed, implemented. The principles are broad principles to be learned. So today, I think, is a beginning, and a very healthy beginning, to introduce to our fraternity, to our colleagues, our existing members, new members, potential members. I would encourage all delegates, all participants, please remain engaged with CEAI. I'm sure the Secretariat of CEAI is galvanizing across, like from Northeast to Northwest, South. Series of very exciting seminars will be made available for professionals to learn and share and really walk us through of what is that practical implementation of theoretical knowledge. And we have the wealth of experience across our members, our faculty, even you distinguished participants bring in so much of information and knowledge we can exchange. Now, coming specifically to how I would like the theme to be introduced, it's really the largest agenda on the list of Government of India, state governments, as well as the private sector, which is growth. Growth won't come without capital expenditure and what we call the incremental capital output ratio. You put in 1 rupee, or you to earn 1 rupee, you have to put in 4 rupees. That impact will come if we have access to well-structured project financing, building around, whether it is a hospital, a metro, or a bullet train, or a dam, a project. You name it, the principles of project finance are literally mandatory to be known, experienced, and kind of used with the client and the stakeholders. I think large number of our colleagues today come from the engineering fraternity, and they are, wizards. They are the best in class in their professions, but a little deeper exposure on what is financial closure and how do actually project financing principles work from the perspective of the project sponsor, other stakeholders, particularly debt. So debt financing of infrastructure is the key elephant in the room. I'm sure Mr. Moitra will walk us through what it takes for a banker or a financial institution or a multilateral developmental bank to commit funds, typically debt funds with low interest rates, long tenors, 30-year loan you can get when you're building metro. You can get a 50-year loan from JICA when you are building the metro, the bullet train project. This kind of long tenure financing for infrastructure would not happen if the project sponsors, typically the government and its parastatals, state governments, other corporations, do not understand in depth what is project financing. I think it's a vast subject. A beginning is being made today by Mr. Moitra, and very ably guided by our moderator, Mr. Das Patnaik. I would like to really hand over to my distinguished colleague, Moitra ji, Subhendu Moitra ji, to walk us through. We have an exciting time ahead. Please remain logged in, attentive, shoot your questions. I'm sure we'll have a fascinating afternoon. Thank you, ladies and gentlemen.
Yeah, thank you, Mr. Mathur, for having given a very good introductory note on the entire vast subject of the project finance. And I just to also add, Mr. Mathur is an eminent governing council member of the CEI, and we are really, very happy and to have him today to actually give his introductory comments. Now, coming to our eminent speaker, Shri Subhendu Moitra ji. Subhendu Moitra ji has a very, very vast experience, more than 33 years experience in the leadership position. He's an investment banker and an expert in project finance. You will not get many people with such a vast experience. He's been, now of course he's moved on, but he was heading as the chief credit officer of IIFCL before he came onto his own to set up an expert advisory company which will provide a lot of financial services. He has been an entity of the Government of India in the past. He has been the MD and CEO of a special situation, ARC, and also the senior vice president and regional head of the SBI Capital Markets, and a very, very premier investment bank of India belonging to State Bank of India, where he has been there for more than 15 years. And I think his career is spaced. And I know Mr. Moitra since many, many years now. And I think I am really happy and really delighted to have him. He's been an engineer and MBA, but he's into banking, project finance, and a troubleshooter and provider of excellent advice as far as project finance is concerned. With these few words, I request Sri Moitra to kindly spare about 45 minutes towards it. And I think we have eminent guests, eminent participants today. We will have the chat box open for questions. And I think we'll have 15 to 20 minutes of definitely very active participation after Mr. Moitra would have deliberated. And this is, as Mr. Mathur mentioned, this is the first of its kind. We will have subsequent webinars on deeper insights onto the project finance, and followed by a physical 1.5 day or 2 days of meetings and seminars, which will also be happening very shortly in the month of September and October. So, Mr. Moitra, over to you kindly, and you can have the support of our CEI governing office in Delhi to also transit the slides if you wish to.
Yeah, please. Thanks, Mr. Das Patnaik and Mr. Mathur, and also thank you so much for giving me this opportunity of interacting with this vast team of experts across the country. It's always a pleasure. And as you know, being an engineer, it always is a special interest for me to interact with my alma mater in a more intensive way. I can request Mr. Maini to please put the slides. Share the slides, please. Now, just to give an introduction, this project finance is a very vast subject, as we all discussed, and we are all looking into the situation we currently. It's a large subject, so we'll try to touch upon a few parts of it to give a feel exactly what it is and why we need project finance, and how should we go about it, and what is actually the bankers look for when they look for a project financing part of it, and where the engineers have a huge, large role as such to play. Can you go to the slide number 2, please? And if you can put the, yeah, sure, thank you. So basically, so this is difference from the normal finance as we do normal funding, say housing finance or normal loan financing or working capital financing, is that it is non-recourse. Non-recourse means if you take a say housing loan or any other loan, or let's all connect ourselves individually. We take several loans and all. It is all dependent on your money. It's nothing to do with the what for which the money is going. So here, in such a cases, non-recourse means it's only the lender or all the stakeholders have the project in hand, and everybody has a role to play, whether it's a developer or a lender or equity holder. Everybody has his own responsibilities and authorities, and they have a role to play, and that risk also is shared accordingly. So that is the basic difference of it. You cannot you can have a very limited kind of support from the sponsors or the promoters, but you cannot have a full support. It's not that if the project goes bad, everybody goes to a sponsor and says, well, I want money from you and he will pay it. It's not like that, which happens maybe when you give a corporate loan or a corporate finance. For a large company, like say any large company, any large houses, if they take a loan on a corporate loan, it's not on projects. So whatever way it is, the money will come from the balance sheet of the company. But in the project finance, it is not so. It is a non-recourse basis. There will be a special purpose vehicle for the particular project that will be set up, and every money, every responsibility of servicing debt or any other liabilities are of the SPV, and everybody has to understand the risk and go into it. Now the question is that, so is it so easy to get project finance? And as Mr. Mathur has very rightly said, it was not very prevalent in our country. In a normal sense, bankers never used to do this kind of funding till these large projects, especially the infrastructure projects, started coming into it. Because whatever happens in infrastructure project, the sizes are so large that it is not possible for one or group or one company to just service the loan or service all the liabilities. So you actually need to have a structure where the cash flows or the project itself services it, and everybody understands the risk about it. So project finance, it is a certain uniqueness. It's against the traditional corporate finance, as I said, is normally for the larger investments, longer maturity, and above non-recourse or limited recourse to the sponsors. It's most effective for the large infrastructure project. However, such projects involve sharing of risk of different stakeholders, and the knowledge of risk and structures of the project finance to handle the risk is paramount. So that's why people who are handling project finance are also supposed to have a very good knowledge of the project finance risks and project finance structures. That's very, very important. Next slide, please. So the now question is it that so new to us? If I give you some examples internationally, and I'll come nationally also later on, it's not so new, but it was funded in a different way. One of the oldest recorded such project finance was in 1299, when English Crown enlisted a certain merchant bank for aiding the development of the Devon silver mines. The bank received a 1-year lease for the total output of the mines in exchange of paying all the operating costs without recourse to the Crown. So if the value of the amount is extracted of or is less than the expected, so they lose. Today, this type of actually loan is called production payment loan or production sharing loan. So this was one of the oldest we see in the history of the project finance. Another, you can say that there was a financing of a specific expedition of the Greek merchants. And another known project finance was found in French concession of 1554, granted to Adam de Crapone for a canal between Durance and Rhone rivers, almost in line with the present build-own transfer model. Another early, trading, if you see all these East India Company, this was also in types of a project finance because some people used to fund it. So the idea was the earlier expeditions of 17th, 18th centuries of these were actually financed by the project basis. So investor provided fund to Dutch East India Company or British East India Company for voyages, and which were repaid according to the share of the liquidated cargoes. So I can even if some of you are from the Calcutta, I know there was a place called Tollygunge here. Tollygunge there was a Mr. Tolly who actually got a concession for making a nala, still there, Tolly Nala. So Tolly Nala was dug by him with the condition that he will have a right to collect toll from the, whatever ships or boats will go into that nala for a particular period of time. So there are examples of that. Only thing, it was not called project finance. Next slide, please. So, but in India, in the current form of the project finance, is started with the infrastructure finance started being there. Now, there's a very basic difference between infrastructure finance and a normal loans, normal project finance, like say normal finance, like say steel or cement. These are a bit different in the sense infrastructure. There's a uniqueness of this kind of projects of the infrastructure. First of all, they have a very long life. These are such a large investment. So if you assume that if you fund a road or a port or a airport, you will get money in 10 years. It's not possible. It has to be coming, as Mr. Mathur has said, 30, 50, 60, or even 100 years loan. The English Channel, there is a channel financing, which is a channel between France and England. There is a 100-year concession. It started at 1986. It will end at 2086. Okay, 100-year concession. This kind of length is required for a very high cost project. So that's first of all, is a long life. It is a large investment. It's immobile. It's not like that. For example, if I fund a particular machine, or I fund an equipment, and suppose there is a default, or there is somebody is not able to pay the money, you just take you just take the car out, and sell it to somebody else. It's possible. Now look at the road. It's not possible that you take the road out, or a port that you cannot. It's not possible you take the port out and carry it somewhere else. It's not possible as such. Secondly, second problem is that whatever the service it gives is to the local people. So if suppose there is a demand shortage, for example, you make a road, and ultimately you do not expect, whatever amount of traffic you expected, you get much less than that. So what happens is it possible that, okay, if you produce something, say steel, you are not able to sell in your local market, you sell somewhere else, you export, you sell to some other zone. It's not possible as such. So it's totally on local demand. So that is another issue of that. That's the difference of the infrastructure project. Then there is a local currency revenue. You cannot export. So, even if you take an international funding, international loan, international equity, international equipment, you have to be very careful about it, that your money, the inflows will be in rupee. So you need to take a proper hedge, or you need to be very careful in how much risk you are taking. So it's a local currency revenue, not like a normal product like a steel or cement, where you have steel, you can always export. Cement, there's a problem, but still you can export to nearby countries. Higher debt equity ratio, because the project cost is so high, the requirement of money is so high. So naturally, it's not possible to have a low debt equity ratio of, normally, if I say in a project of a normal project, it goes up to 60-40. So 60% debt and 40% equity, or maximum 2:1. So 67-33. But in case of infrastructure finance, it's normal to have 70-30, 70% debt, 30% equity. It can go up to 90-10 also in certain cases, especially for annuity-based road projects where the NHAI gives annuity. It can go up to that. So it's a very high debt equity ratio. Major role and stake of the government. We'll discuss that. The government has a very major role, and hence vulnerable to regulatory changes. Now, why government has a major role? Because in the infrastructure project, what happens? Whatever we handle are actually public good. Whether it's road, or it's say power, there is a lot of public goods or public sentiment in stake. So there has to be the government role in that. Politically sensitive tariff. It's very natural, because you cannot have a tariff which is not in line with the local expectations, and you need to have a problem. I can give you an example of the Dabhol, which happened. What happened in Dabhol? Basically, it was linked to the international prices, and it was based on naphtha, which is imported. When naphtha prices went up, the power prices, which was initially at say 6 to 7 rupees per unit, that time went up to 20 to 23. So it becomes unviable. So it's a politically sensitive. You just cannot increase the price. In other cases also, there is a demand, so you cannot increase this, and rightly so, because as we said, that these are the things where there is cannot be a lot of competition as such. Like you have a road, you cannot, because that road has become so good or so useful for everybody, you cannot just increase the price of the road or the toll of the road, which is not right. So there has to be certain regulation and certain government role into that. Service is quasi-public, which is we discussed. Hence, full cost pricing may always not be possible. So we may have to look for viability gap funding scheme. There are viability gap funding schemes. For example, the metros. Metros are not generally possible to be funded fully by on a non-recourse basis. So what happens there? The government normally asks for bids for a viability gap funding. Whoever demands lower viability gap funding, they are normally given on that particular project. So that is what, there may be cases where it may not be possible to totally get it financed or totally get it funded from the cash flows of the projects. So there may be some government subsidy requirement of that. It's a non-recourse funding, which we have already discussed. Next slide, please. Now, so these are the special features. Now, certain important points we have to understand is that in infrastructure finance, project risks are identified. What is done in infrastructure finance? So as we said, it is basically the play between various risks. So what we do there, we try to identify risks. What are the various risks are there? Clearly demarcate and allocate to very relevant stakeholders. For example, if you are setting up a project, there may be a situation where the somebody is actually is an EPC contractor. So he should have a responsibility to complete the project or complete the process in time and also within cost. So better to give take a fixed time, fixed cost guarantee scheme, and there should be sufficient LDs within your contracts so that risk is allocated to the EPC contractor. Now, suppose he fails, it's not possible that somebody else will take over, the sponsor will take over that risk, which is very, very difficult to take it. So this is how the allocation and clearly demarcation and allocation of the relevant stakeholders, right stakeholders, who are the best ability to bear any particular risk need to be there. There should be more importance to cash flow as security. So there should be, we'll discuss that later, trust and retention account. Normally what happens in other cases, you might have heard this word called escrow. One is a escrow, one is a TRA. Now escrow is somewhere, do I need to be more clear? Can't you hear me or is it okay? So basically,
local issue might be there.
No, I think it's okay. I think we can hear you very clearly. There's no problem at all.
Okay, fine. So basically, as I'm saying that in escrow, you capture the cash flows. In TRA or trust and retention account, you do not only capture, you also exactly decide how the cash flows will be used. Who will have priority over whom? That's a trust and retention account. So only in a normally, if you find a normal funding, lenders will have an escrow where they capture the cash flows and they take the money from them. But in case of, say, road, if you capture and everything is given to the lender, ultimately how the roads will run. So it's not possible. So there has to be trust and retention account where the money use will also be prioritized. In fact, let me tell you, there are certain use which is above the lender. That is that for O&M or operation and maintenance, that expenditure comes before the lenders are serviced. So this is how specified it is. So there is a trust and retention account, TRA, and transparent regulatory framework. Now, transparent regulatory framework is very important because when there is risk, so I should understand what is the risk and how much risk I am allocating all the stakeholders, whether it's a sponsor, whether it is a EPC contractor, a O&M contractor, a lender, or anybody or any others. Say, suppose a concessioning authority, say everybody should know what is the rule, what are the ground rules, who is having how much risk, and what happens if somebody is not doing his duty properly. Next slide, please. So now question comes that project appraisal. Who does project appraisal? So normally what happens initially, the sponsors and the concessioning authority, they will decide and they will structure a project. And after the project is structured, they come to a lender for funding. So when the lender look at it, so that is called appraisal. Appraisal is actually basically having a second look into the numbers, because when the sponsors have taken up a project, he has done his analysis. He has done his analysis of the bid and accordingly he has funded it or he has structured it. So ultimately somebody has already seen it. So lender will see it a second look at it, the whole number, the structure, the risk, to find out that whether it is financially viable on a banking angle or bank wise, what is the bank lending wise, it is viable. So now this acceptability of the proposal varies based on institution's lending model. So when I say lending model, there may be institutions who might have decided that they will fund a road project based on only up to say 80-20 debt equity ratio. There may be some aggressive lending institution who may say I can go up to 85-15 in case it is a NHAI annuity project. So I'm thinking there may be various lending model or lending policies which can differ. Each institution have its own appraisal format, but the basic parameters are similar. And it's a second look in the project, as I have said. An analysis of risk and mitigants is what actually is done. So what the appraiser will do, what they will do, they will try to identify the risk in the project, first of all, various risks. They'll note down all the risk, assess and quantify each and every risk. Possibility of litigants, it's if you believe that there'll be risk-free, it's not possible. Risk-free lendings are only like government securities, though there is a different type of risk we can discuss later, the political risk is on. But generally, in an internationally or in a domestic angle, risk-free, lending is only, buying a FD or of a AAA rated bank or a government security. So, somebody has to assess and quantify the risk and possibility of the mitigation of the identify risk and mitigants. For example, once I find a risk, I know this is the amount of the risk is there. For what I can say I believe that there is a chance of the project cost overrun. So I will be looking into the mitigant in such a way that I'll see whether the EPC contract has been given on fixed time, fixed cost basis, and whether sufficient LDs have been, captured in the agreement of the EPC contract. So take care of. I will answer these questions. I think some questions are coming. I'll answer at the end of it. Maybe, okay.
Issues we'll take up in the end.
Yeah, sure. And last is that to decide on the acceptability of the project. It doesn't mean if there is a residual risk, so the projects will not be taken up. So you first mitigate the risk, then you see what is the residual risk and whether that risk can be taken by a lender. If it can be taken, then you price it. Prices means when your risk is higher, then of course you price it higher, you have a higher rate of interest. You may ask the sponsor to give a more equity. So these are the pricings of the risk as such. Next slide, please. Now, as I said that we need to discuss this, that role of the government in infrastructure. Now, role of the government is infrastructure is of course the policymaker, regulator. Now, whether they should be concessionaire, developer, operator, concessioning, so that needs to be done because these are the three roles as such. Now, if you see initially when all these sectors were opened, whether it's a power or the road, government was playing all the roles. So let us take what was there, State Electricity Board, power. There were government entities. So they used to make their own rule. They used to regulate. They used to be the developing also. They are project, constructing power projects. They were deciding initially the prices of the tariffs also. But then subsequently when the Electricity Act came, it all changed. Now, why it changed? Because there'll be conflict. So until the one player is doing everything, it is okay because they're all within them, the various departments. But once you invite outsiders to invest. So when, we opened in 91, initially we opened our power sector only for projects like Dabhol or Spectrum, 4 or 5 projects actually came up. Then we had to have our own rules and regulations. So, but then what happened that time, even that time there was a mix. So though we allowed outside people, outside investor to invest, the same State Electricity Board had their own own generating systems and they were competing to each other. So there was a conflict. So what happened then subsequently Electricity Act came because of the various issues were there in the power sector. ACBs were in a bad shape. Certain investors were getting jittery. And so it was decided that there will be a regulator and unbundling of the ACBs. So basically there will be a generation, distribution and transmission. This will be unbundled and there will be a regulator, a central regulator, and also every state has a regulatory agency. So basically the players where ultimately that was a regulator has to be there who will decide the ground rules and who will decide that if there is any mistake, and they should be very independent and transparent. So the best structure is government should be in the policy making, and there will be players who will be like, it can be a PSU, it can be a private player but the regulator has to be independent and transparent and independent. So this is, if I look at the various sectors today, especially infrastructure, power is structured. Power, you have already that. Road, still we don't have a regulator. So there is I mean, I'm sure some of you who are handling NHAI, there are still several disputes going on. NHAI is a player. It's also a regulator. It's a concessioning authority, and also it is a regulator. They decide, whether they should pay the termination payments or not. There's a huge dispute. So if I have to pay termination payment and I only decide that whether I have to pay it, so there is always a conflict on there. So that keeps on happening. So maybe we should have a regulator. If we look at the airport, there's already ERA, Airport Authority, Airport Regulatory Authority. If you look at the port, there are port authorities. But if you look at the municipality, if you look at the railways, if you look at the roads today, there are problems because we don't have an independent regulator. So for a sector to mature and sector to be ready for more of outside investment, so better structure is the government should be in the policy making. There should be independent regulator, and they should, all the players should be there fighting, competing with each other and have a very level playing field. That's it. Next slide, please. So now let's look for some of the types of the risk. What are the various risks at the various phases? Highest risk is, of course, as we go ahead until the completion, the risk comes down. So highest risk is initially. So risk is the development phase, when the risk is very high and where only equity capital is used. You should not use debt. So debt should only come into the picture in a much later stage. Now I also find, because I'm now discussing with a large amount of engines, I also find various discussions which says that, well, if equity holder is putting money, why, if he's taking a risk, why a debt funding will not taking a risk? Because there is a role-wise result different. Equity investor, he has a risk and he has a higher return also. Look at the situation when things are very good, equity investor will get a higher return, but the other lender, he has only downside, he has no upside. So he is always in a higher position to recover the money. So there has to be some difference on that. So when the risk is high, you should not bring a lender there. It should be more of an equity investor, because he can take a higher risk, he has a chance of a higher return. So that's why initial phase it should be funded by the equity only. Second part is that implementation phase. Here also the high risk. Implementation of the project is being implemented. Say a road is being constructed, then or a power project is being constructed. The high risk, require large volume of finance, because you have so many construction work going on. You have to keep on paying those EPC and other contractors and other people. Mixture of the equity, sub debt, senior debt, guarantees, these are used during that period. After the projects are complete, it's an operation phase. So the third phase is the lower risk. So here you normally do refinancing. Now here let me tell exactly how international it happens. International structure is that as you go and move forward, initially you fund with a normal loan from the bank institution, and as we complete the project, you go for a bond funding. Now unfortunately in this country, the bond funding has not matured so far. Now why is it has not matured? Because still the pension funds or the the funds like insurance funds who have long-term money, they are not capable to fund these projects, because these are high risk. Even after operation phase, these projects are rating. If you ask me, if you understand rating, see, anything above BBB is investment grade. So it may be investment grade, but it's not so high rated, or say AA or more than that, where these people can invest. So internationally, what happens? There are agencies who give credit enhancement, partial credit enhancement. Somehow in our country, regulation wise, that has not worked so far. Now I come from institution of IIFCL. We had a scheme called partial credit enhancement scheme. That is active. They are the only one so far who has funded a couple of projects under partial credit enhancement, but it has not been active. So it has not been so popular even now. So, but internationally, but one more thing has happened in the last couple of years. A group of agencies or group of funds, like mostly Canada pension funds, international pension funds, they have come And Government of India has come with a new scheme called InvIT. So it's a trust infrastructure, funding trust. Basically, they in the trust mode, it's a tax efficient mode where the money comes internationally and also the loan is read internationally, and they ultimately acquire completed projects and then they issue the bonds. And because they take so many projects, there's a diversification of the risk. If I have one project, the risk is always higher. If I have 10 completed projects, the overall risk will be coming down, because if one project goes back, the other project's excess cash flow can be used for that. So the ratings of the overall package comes down. So under that, the InvITs, where the most of the InvITs have been set up by various international pension funds or KKR or those kind of funds, they're taking over such projects because they're a lower risk, and those international funds can come and they can they look to invest there. Because look for that, the situation is those kind of pension funds, they look for a very long fixed return kind of investment. They don't look for a very high return investment, but they look for a very long period and less risky and fixed return investment, which infrastructure can give in a very good way for a long period of time, because these projects are normally 20, 30 years projects or even longer. Next slide, please. So next, let us discuss with some of the various risk generally for the project. We have discussed earlier slide types of risk or various risk at various phases of the project life. Now let us discuss various project risk. When we do the appraisal, what are the risks we look for it broadly? There may be so many others. Broadly, these are the risks which we can discuss just to give a feel about it. When you discuss for a long 1 or 2 days, we can discuss at least 30, 40, 50 or 60 type of risk, and with the case studies. Sponsors risk. This is the equity commitment risk. So basically a sponsor, whether he has a capability to bring that much equity money in a right time, that is the sponsor risk. So you have to basically look for the sponsor, that risk of whether he'll be able to give the equity commitment or any other thing if he's supposed to do. Because in some cases, sponsor is also the implementation agency, whether he has a capability to implement such projects, managing such projects, such size of projects. That is another important in particular sector. Market risk, take or pay. Market risk, take or pay, or traffic study, these are important. Market risk, what happens that suppose you set up a road and ultimately you look for, before you set up the road or a new road or greenfield road, you do a traffic study. You believe that so many cars are going to be going through this road after it's completed, but there is always a risk factor. If what happens, it comes down. So this is the risk of traffic study risk. Or there is a risk called take or pay, which happens mostly in power. Suppose I set up a power project, then I actually go with various power distribution companies and tell them how much power they require. Based on their demand, I set up a project. They give me a long-term 25 years agreement, but there should be take or pay. Suppose tomorrow I produce and they said, no, I will not take it. So there should be some fixed cost which I should be able to recover from them. Otherwise, it's not that if they are not taking, I can sell somewhere else, though there can be other ways of selling to, say, a different state through interstate grids, but that's not easy. Of course, today you can even sell power on spot, but that's not easy. So at least a particular amount of power from my power project should be sold on a long-term basis, and there should be assured pickup, which is called take or pay. Especially for a lender, how the lender handles it. Indian lenders specifically are not very, very open to a project which is coming based on only selling power on spot basis. They always look for at least a agreement to have 60, 70% or 50, 60, 70% of the power generation to be picked up by a long-term agreement, so that their loan portion is serviced out of that. After that, if the sponsor want to take a risk of balance 20, 30% of the generation because they want to take benefit of the demand of the power, that's okay. But a lender, as he said, lenders are not having upside. They're always averse of a downside. So they will always like to have a long-term agreement for a power project, which will actually give them a assured their money will be returned back, their loan will be returned back. So basically a DSCR, if we have to tell him that at least a DSCR of 1 or 1.1, they need to be assured from the long-term take or pay. So that is take or pay. Now, on the traffic risk, I can tell you one particular example. I funded this, I appraised the project of Noida Toll Bridge. Some of you are in Delhi, you understand the Noida Toll Bridge. Let me give an example. This project was completed in time, within cost. It was one of the first toll road projects of the country. But the traffic study, which was again done by a very internationally reputed consultant, because India didn't have so many traffic study consultants that time. And it actually projected that on day one, after completion of the project, number of vehicle on the road will be 1,17,000. And I remember it was 17,000 vehicle initially to start with. So that was a type of risk. Now, there was so many questions on that, why it happened. There was analysis on that. Of course, there was a different story happened because there was a discussion that kind of projection which was taken, considering that the development of Noida will happen. That much development did not happen in Noida during that time. Rather, development focus was shifted to Gurgaon that time. So the number of traffic after the completion was less. However, let me also tell you, see, India is such a market with such a growth story. None of the lenders, though they had to do a restructuring there. So when people say that NPA restructuring, I said, don't get worried, because Noida Toll Bridge was restructured. But however, they prepaid the loan with all the recompenses within 5 years of restructuring, because then the traffic became so high, they actually could pay everything. And ultimately, of course, there's a different story happened that, that they had to stop tolling because there was so much toll, so much traffic. Their overall cost was, the return was already satisfied. So that's what I'm saying, that, the traffic study is very important. But initially, if you look at it, it was a mistake from our part as a lender to assess the traffic, because the traffic study was not right. Or maybe that time our capability of assessing traffic was less. Now, I would not say that we have this much, we never goes this much off track on traffic studies. I've not seen so many projects which have so much difference as such. Third point is inflation. So index linked traffic. So as you see that there will be, there is one part is that, there will be your traffic, whatever is your traffic, the tariff, that has to be some index to the inflation. Otherwise, what will happen if you have a very long 25 years agreement of take or pay without inflation? So you're going to have a risk, because your cost will go up, your other charges will go up, your fuel cost, if you are using coal or something, your fuel cost will go up. So you need to have a inflation linked tariff in such cases, because as I said, in these kind of projects, there is no one to fall back upon. There is not a large, big daddy is not there where there is any shortage of funds, somebody will fund it. So everything has to be captured within the cash flows in the project itself, and all such risks have to be captured. So if I find there will be a chance of a higher inflation, or there is a chance that the fuel prices can go up, so we should try to link it with some international index. So that is the way it is done for a lender or for anybody to be safer. Currency risk, hedging, exchange index tariff. So this is one of the risks which is also pretty important. As I said, in all infrastructure projects, the inflows are always in Indian rupee, whereas the outflows can be in foreign currency. If you're importing anything, importing a fuel, so it can be on that also. Force majeure is, of course, we can cover through insurance. Regulatory risk, government support with a stable and transparent regulation, independent regulator, we have already discussed. Can you come down a bit? Yeah. Now, these rate things actually are something which, to be honest, if you are doing international lending, you do it. I'm sure, our Exim Bank, when they do funding in other countries, they do it. That's called country risk, host country risk. Now, there is a political risk insurance, PRI. And so these things, if we do international funding, you are supposed to take care of that. And this political risk insurance is actually a product which is given by the multilaterals. So if you go to ADB or a World Bank arm called MIGA, you will get a political risk insurance. Suppose I want to fund a project in Nepal from India. So there is a risk, higher risk there. So you are better take a political risk insurance. I can give you an example. Malé, an airport was set up by one of the large houses in the country. Ultimately, it was nationalized after some time, and they didn't take any political risk insurance. So there was a huge loss that time as such. In fact, I asked the banker who funded it that why didn't you take PRI? It was not taken. So these are the risks which need to be covered. We need to understand if I am doing a cross-border funding, I need to be careful about the country risk and the political risk insurance. Next slide, please. Next slide, please. Now, this is what I think which is very important, the construction risk and completion risk. Now, construction risk is that actually we discussed during construction, if there is adequate LD is there, contingent provision in the cost is there, startup of insurance is there. These are important because as I said, you have to always look for this situation that what can go wrong and how am I covering that? As I said, again, I think I'm repeating this, that there is nobody to fall back upon. And there, if everybody will be a loser if we are not covering one of these risks as such. Completion risk. So the EPC contractor has to give an adequate guarantee and LD provision for the completion. There is normally a completion test which is captured in the contract, which says that on time, within budget and cash flows, within cash flows, it is important that we should be able to achieve this on time and within budget and within cash flows and all. So for that, this completion risk and completion test is important. So as being engineer, I'm discussing with the engineers, you need to be very careful on that, and you have a big role to play. So whether you are from a EPC contractor side or for a concession authority side or from the SPV side, you need to be very careful about that because this is a very high risk, and there should be properly covered of it, and there should be sufficient provision for that. Fuel risk. Now, fuel risk is a pass-through structure, long-term supply contract. This is, as we say that here, in power, Coal India gives a long-term linkage. Now, look for the project, the mega projects when it came. If you remember the project called Mundra, Tata set up this project based on Indonesian power, Indonesian coal. Now, what happened? They took all the mitigation, I must say. They actually purchased a company in Indonesia who have Indonesian coal and also have a long-term contract with a transporter for transport of the coal to Mundra. But what happened? Suddenly, there was a change of law by Indonesia. Earlier, before that, in Indonesia, if you wanted to take some coal out, you can decide your own price. That they changed the law that whatever coal goes out of the country has to be based on the international prices. So ultimately, the whole economics went bad. So it ultimately again had to be reworked. The tariff had to be reworked. Supreme Court has to give an order, and then only these projects could come through. But this is a risk which was not actually captured, if you ask me. So this is a very important risk as that pass-through structure of fuel has to be there, because this risk now in case of solar power, this is not there because the God gives us solar energy. So that is the advantage. There is no fuel risk in a solar power. There may be other risk, but not that risk as such. Technical risk is the O&M contractor. They need to take care of the technical risk part of it. Now, environmental risk, that is one of the most important, which is now you are all aware, is hazard and accidents, which needs to be covered. Resettlement, rehabilitation, that part from ESG studies has to be there. EIA studies have to be there, and lenders also look into those studies and sometimes put their own agencies. In fact, institutions like IIFCL have their own ESG team who assesses such projects, and all the multilateral institutions, they have their own team to assess such kind of environmental risk. Next slide, please. So this is actually, I'm just giving a picture of this. So this is how the project structure looks like of the infrastructure project. So don't get confused too much. Just to give that, these are all various parties connected to various agreements. So that means the role of the agreements are very important. And that is why the role of the regulator is also very important. And that is why everybody needs to understand these agreements, and these contracts to understand what is the risk and who is having how much risk, what happens if somebody fails, and how I am protected or the whole project is protected. So special purpose vehicle, they are related to the sponsor, they are related to the, the construction company, the equipment vendors, O&M companies, they all giving guarantees to each other. And the lawyers, of course, are everywhere. If you see this, if you have so much agreements, if you know Lawyers have a field day, The suppliers are through the supply agreement. Then the off-takers are through the take or pay agreement. Transporters are through transportation agreement, and government is there through the concessioning authority or other agreements as such. So this is just a structure. Today I cannot discuss this because it's basically difficult to discuss on a online mode. So if you ever get a chance to be offline, we will try to discuss in detail, and you may enjoy this part of it, I'm sure. And we can discuss with the case studies also. So next is next slide, please. Or if you want to put this slide for some more time, just you can, or just yeah, just see the parties there. Who are the various parties. If you don't understand, let me tell you, ECAs at the top right are basically, these are the international agencies who guarantee their machine exports and all. Okay, so they are like a bank, but who actually promote machine exports. For example, our Indian Exim Bank also, gives this kind of support to certain countries for certain products or certain of our producers or equipments. So this is one of them. And any other thing, O&M, you understand, equipment vendors, construction companies are EPC contractors. So these are various parties, and these are the various contracts through which they are connected. So this is just to give an idea that this the whole structure of the projects. So if you ask me what actually a lender or a project finance lender assessor does, he first, after taking the project concession, he tries to draw this, see who is having what contract, and then he tries to catch hold of all the agreements and read it or give it to his legal counsel and give a report on that. So this is how it is start with, so that to understand the risk. Because without understanding this, you will not understand the risk at all in this project finance. In fact, I'm sure the sponsors also do that. Next slide, please. This is what I said, that the trust and retention account we will touch upon today. So this is the difference between escrow. I have said. So there is a waterfall, and there is something called permitted investment. I will come to that. I will come to the next slide, and then I'll come exactly what it is. Construction phase. See, when you are constructing a project, so what are the inflows? There is no cash flows generated. So there is a debt, there is a equity, income from investment in case, because you have some money in the system, so you invest in a FD or somewhere, so you get income, interest. So that is the income. Then there can be a subsidy or from the government or any other agency or government agencies. Insurance proceeds in case there is a mishap. And outflows during construction are basically statutory dues for any company. Payment of the EPC contractor because they are constructing the project. Administrative cost like your own salaries and other things. Debt service because the interest during construction is actually service, though it's service from the debt only, but it is actually service. And they also sometimes have to create a DSRA, debt service reserve account. So normally lenders ask you to put 1 quarter or 2 quarter of their repayments or interest in an account, actually capture it. So that's called DSRA. So these are the outflows. Come down, please. Operating phase. Yeah. Operating phase inflows are again revenue because your operations have started. Income from investment. Income from investment because same thing. You have some excess money, so you put into investment. Your subsidy can continue because there are certain cases the subsidy comes year-wise even after completion. Of course, the insurance proceeds come anywhere. It's a sudden thing which can come up. Outflows are statutory dues. O&M because your EPC is not there, but there's maybe O&M expenses. The fuel cost if you are importing or buying fuel. Debt service always will be there. DSRA will naturally be there. Major maintenance which comes every couple of years, but normally you create a major maintenance reserve. So the major maintenance in a road especially is very important, or even in other large projects like port, airport, you have a MMR, major maintenance reserve, and a surplus account from where the money goes back to the sponsor or somebody is distributed. Come down, please. So this is how the waterfall looks like. In the construction phase, the left side, say who gets priority or what. So the bucket, first all the inflows go there. Then first you pay statutory dues. So whatever money is left out of that you pay to the EPC. After that you pay to the administrative cost. Then after that you service debt. Then you create DSRA out of whatever money is left. And again excess money if any goes to the construction account. But in case of operating phase, what happens? Revenue, income from investment, insurance, that all are coming into the upper bucket. That's the main bucket. Statutory dues are paid. O&M fuel supply is paid, then the debt service is there, DESRA is there, you create major maintenance reserve. If something is there, surplus is there, you actually pay to the distribute to the sponsor based on the agreement. So this is how the operating phase looks like. So I have a few more slides on infrastructure sector, but I think we are almost end of time. So
no, you have another about 5 minutes. Kindly go ahead, no problem. I think
okay.
people
So
are appreciating that.
I think this is very general. So you should know just the importance of the infrastructure. See, it said that spending 1% of GDP of the infrastructure likely to boost economy by 2%, double of it. This is essentially global study. Global has studied this. Internationally, it is there. So late 80s, 90s, infrastructure was totally under government. We all know through budgetary support, projects were awarded to EPC route. However, this was not sufficient. So when you decided to open it up, we went for a PPP model, public-private partnership. And actually, our services have also improved. The roads have improved. Look at the roads. Look at the airports. Look at the certain stations. We funded from IFCL a station in Bhopal. Look at the station. It's more than an airport. So things have improved a lot. So the PPP model came up in 90s, and sectors started opening private in 90s only. With the economic growth of 7%, it's exposed to a grave negotiations, because if the infrastructure is not there, you don't have a road, you cannot take your product out, you will have a problem. If you don't supply, you're not able to take your wastewater out, or your supply water to your industries in proper time, you are going to have a problem. Industry will not be able to survive. So the policy making bodies have acknowledged that the state of infrastructure is a drag, and perhaps by 1 to 2% a year was there. But despite we have done a significant development, but still we are ranked 37 among 63 economies in World Competitive Index 2022 by IMA. So though I would not say let's not get very perturbed, because we are improving fast. Not only that, it also shows that kind of opportunities we have, or kind of investment that can come in this sector. I will say particular sectors have not yet opened, like railways, water, municipal sectors are not opened at all. So there's a huge opportunity in this country as such. Next slide, please. Current scenario is, you see that 24.7 lakh crore is a total lending by the bank institution to the infrastructure. But what is our requirement for NIP, National Infrastructure Pipeline? By 2025, we have to invest 111 lakh crore. So it's nothing. And then let me give you some more picture also. Now, India has decided by 2030, we should have 500 gigawatt of green power, renewable power. For that, the investment assessed by us is $250 billion. So this is not coming under that. It will come up to 30. And by 2070, we want to be net zero. For that, the investment is huge. Again, international agencies have International Energy Agency has assessed that we need about $160 billion per year to achieve that by 2070. So the amount requirement is too high. I'm saying the amount which was so far spent is again minuscule. We need to have a huge amount of investment, which will come not only from the loan, that also from the bonds, but from the international investors. And for that, we need to have our structure in a proper form, which has already happened. Last couple of years has been very, very encouraging in that. Can you go to the next slide? This is okay. Next slide, please. So this is what we can see is that ticket sizes will remain large of such loans. So there'll be more of a concentration risk, and hence asset quality related shocks are expected. Though I would say until 2021, even during Corona, this various infrastructure subsectors were quite resilient in debt servicing perspective as compared to other sectors, which is very, very good as such. Because that shows our structures are actually working well. That means our project, structures were quite robust. And this 111 trillion rupees of national infrastructure pipeline you have said. And in addition to that our Honorable Prime Minister has announced Gati Shakti Yojana, 100 lakh crore project for developing holistic infrastructure. Last Independence Day, he declared a mission which is aimed at breaking interministerial silos and to integrate the planning of the infrastructure project. So these are the requirements are quite huge. Some we can see also in the roads and other sectors. So thus, the expected pickup of the demand is likely to coincide with the recovery of the balance sheet with the NBFCs. So I think continuing future, I think more of the NBFC, IFCs will invest much more or will give much more loan as compared to the banks. And as per NIP report, the existing source would be able to finance only 80% of the capital expenditure. And while the some portion can be filled through DFIs and asset monetization, and balance have to come up from monetization of the operating assets. The government has also decided on the national monetization plan. RBI has earlier understood to have diversified financing options and targeted public investment, NIP, in other large new projects in high-speed rail, and which can ignite the economy. And funding through National Monetization Plan, NMP, government has declared. If you have seen that InvITs of the NHI are as a part of that, further augmentation is possible through InvITs, and which has become a very major vehicle for inviting FDI, and very successful also. But the promotion of the corporate bond market still continues to be a very matter of concern. It is not yet developed to the extent which you are lab to have developed so far. Next slide, please. Certain issues to be resolved is that allow relay financing. Now, what happens? We were telling that there's a 100-year concession is possible, as I said, the channel funding, which I discussed. But in our country, if you extend, suppose there is a 50 years concession, you have initially given a 20 years loan. If you want to extend by another 5 years, it's treated as restructuring by the regulations. So there needs to be some work need to be done by the regulator. And and second point, which is there, is a dealing asset classification with the COD, because sometimes say Hydel project, it takes about 8 to 10 years to complete. There may be delay. So any delay above 2 to 4 years can make it an NPA. So this part also needs to be seen, because unless in some cases because I handled some case last year where the delay was by a month, but it has to become NPA because as per the regulations. So this is, I think, we need to avoid to some extent to create more incentive for funding such project. Long-run disputes needs to be resolved. Especially the regulators should be there in all the sectors. I would say that road and which is opening now, that in municipal sector and also railways, we need to immediately have regulators in place. Ensure early release of the termination payment by concessioning authorities by NHAI. There's some delays because they themselves are the regulator in some cases. So this needs to be looked into. Land acquisitions, approvals, clearances, this is another risk which needs to be looked into. Some sectors have to be added, like EVs and hydrogen. These are not yet infrastructure. They need to be added to the infrastructure sector. Next slide, please. I think we have ended there. So thank you so much. Any questions? We can take questions now. But I can only say it was a very short time. So I'm sure some of you might be getting a bit stressed, but don't worry, we'll meet again to clarify certain issues.
Yeah, Mr. Maitra, thank you so much for your wonderful encapsulated presentation. I know we could not do justice to the entire vast subject, and Shri Mathur also, with his vast experience, also could have provided more light. I see some questions, if I may also permit. Some questions have been raised, but there are some specific questions which have been raised pertaining to specific project funding, which I think could be kept out of the perhaps the ambit, the discussions. But I think you can see those questions which are coming on the screen now, and if you would like to answer them or address them in your own way, and Shri Mathur can also add, that will be great.
Yeah, the first in the soft loan. Actually, see, the banks do not have the resource for giving soft loan. To be honest, it is something which is again a regulators or a authorities area, because unless you have a soft loan as your source, it's very difficult to give a soft loan, because you have to actually service a guy who has put money with you at a whatever rate. So giving soft loan is that not an issue, but it's a very important part. So I think it should come from some other source, and it's a very important area as such. But these consultancy, there is certain, I know there are certain projects like even Niti Aayog and others, they have this soft loan scheme for a new upcoming things. This project, there is soft loan schemes are there for consultancy firm, but only for specific things. But for a matured sector, there may not be any soft loan requirement for the consultancy, but that's my take on that. Anybody, any other?
Yes, second question is from Kanaya Ananda. It is there on the screen.
Yeah, so this is engaged in research utilization of Ganga sand and it's a position to utilize a different angle needs investment means to term need finance we are requesting. No, I mean, we can discuss this offline. Maybe this is a very particular project. Exactly, if I understand that exactly what is the project and what are the structure of the project, we can always get a structure done in such way. Is it a part of Ganga action plan? I don't know. If so, then it can be funded. They're being funded by the agencies, institutions. Yeah, presentation is there with Mr. Maini. He can share it.
There are a couple of other questions also. And
Yeah.
if you see in the chat box, you will see in these cases that he has mentioned, Mr. The name is not mentioned, but I think it will come out. Mr. Maini, can you flash it on the screen? Don't mind?
Yeah, just wait, sir.
There's a question which if you can read it out.
Yeah.
Sir, I have seen the lots of PPP projects not getting bidders when floated. For example, the pond and the EV stations and gardens STP reuse. Only success is road where the toll can be collected. Please suggest some ways to make PPP a success.
No, actually, if you are not getting bidders, then because project has not been structured properly. If you actually structure the project properly, you will always get bidder. Then that means the project, whoever has structured, he has not put money, because the concessioning authority also needs to structure in such a way it's remunerated to everybody. You know, it needs to be remunerated to everybody. Everybody should make money, required money, not a very high end of it, but some reasonable kind of return has to be there. So if it is not done, it needs to be structured properly. So I think the concessioning authority will require some advice, expert advice, to structure the project in the right way. This is what my normal take on that. But any project, as we said, that if there is a gap in viability, it can be funded by the viability gap funding scheme. So any project can be made bankable, but it needs to be structured properly. That's the only point I have.
The question was Swangi is there.
Yeah, and road is actually very nicely structured, doing very well. And whenever, let me give you an example, when the toll roads are not getting funding because there are issues on that, they went to the HAM, hybrid annuity model, which is done very excellently well. And again, now because the economic development has come back, again they are going to the toll funding, because again there are funding agencies, it's viable. So the viability is a basic question. It's not that some projects is getting funded, bidded, or some are not. If the viability is there, it will be bidded. Next one. Huh?
There's a question on the waste to energy.
Waste to energy. There have been projects which have been funded, but I would say initially there are some projects which have actually not done well. Various issues were there. Technology issues were there. So most of the cases, the technology which came, they were not successful. Then there were issues of the waste getting. They're getting the sufficient amount of waste. So these are the two issues. Again, I would say that unless the maturity comes in such waste to energy project, it may be supported. Right now, if I remember, the Renewable Energy Authority, they have giving a subsidy also. I think 50 crore or more per project, 50 to I think per megawatt, some subsidy is there. So that has made the project viable. Initially, there were some issues on the viability. So power cost was coming more than 7 to 8 rupees. But now solar is available at 4 rupees, 4.5 rupees. So on competitive basis, they are not getting. So there needs to be some additional support required from the authorities for such projects when they are not viable, because waste to be converting waste to energy is very important. So that has other income out of it, which is not tangible all the way. So there need to be some more support from the government, and so it can be made viable. Initial projects did not actually do well. In case of the capital budgeting mutually exclusive project, is there a conflict between MPV and IRR? Which option to be accepted and why? See, I would say that NPV IRR, there is not much conflict. What the lenders or say everybody looks at, that IRR should be more than your cost of capital. That is very important, first of all. Secondly, the equity IRR should be reasonable for somebody to invest. So these are the basic part of it. And so basically what I say that I would, as a lender, I would look for the IRR, which is more than, and of course the DSCR as a lender angle of it. But the equity holder should look for both NPV and IRR. So I would not say there is any conflict on that, but it should be case to case basis based on the cost of project, cost of capital of each and every project. It needs to be seen from that angle. Repayment loan going to be allowed? Yeah, repayment of the loan, moratorium is allowed. Moratorium is always allowed. It's the 1.5 to 2 years moratorium you get in projects. Next question.
The one more question is there, sir.
Yeah, I just try to.
What should be the ideal IRR to be considered in?
No, there is no ideal IRR. As I said, there is no that there are projects like, for example, I'll give an example. A toll road project, IRR will be higher, risk is higher. But look at the HAM. HAM, you are getting, after you complete, you are getting your money from the government of India. So the IRR will be much lower than that, because your cost of capital will be lower and your return expectation should also be lower, because you are taking a risk on the government. You are only having the risk of the completion of the project. So the IRR will be lower. So there is no acceptable IRR. It is only case to case basis difference. Only thing I believe that there should be cost of capital IRR, there should be sufficient gap of 2 to 3% at least, 3.5%. Then it should be viable. Equity IRR, again, I think, see, equity IRR, look at yourself. If you have to invest somewhere, how much return you will look for it. Again, if you are putting in money on an NHI HAM or NHI annuity, you will look for a lower equity IRR. Anything above 8, 9%, 10% should be okay. Or 11%, 10% or 11% or 12% should be okay as such. But if you look for a toll road where you are taking high, you should look for 15 to 18% return. For power projects, they look at equity return of 15.5% on whenever they go on CERC model. So that is for the power project. So normal projects should be 15 to 18% is a standard equity IRR requirement. But if I'm taking a risk on the government, I can go up to say 12%. That's what I'll tell.
And I may only add that, the project equity and returns are more often than not a function of the regulator. If you're in a regulated regime, then the regulator will do benchmark returns, and depending on the cost of capital, he'll cap the return you will get.
Now, as Madhur Saab has said, let me give you an example. In airport, what happens? They call it true up. So what happens in an airport? You bid for a price, and every 5 years it true up. So true up, the authority decides that whether you have made more return last couple of 5 years average or less return. If you have made more return, that reduces the user charges. If you make less return, they increases the user charges. So they actually ensure that you get a regular return, but they don't want to make a super profit. Infrastructure, you are not allowed to make a super profit, because as you said, it's a public good. It's not something like like a normal speculative business. So it is very important that a regulator has to look into that part of it.
The last question.
Please suggest guideline documents to be referred to preparing RFP based on, see, the HAM and on guidelines. You have to go to HAM. If you ask me, you have to go to the NHI site. There is a sufficient, model concession agreement and other documents available. So I don't know any, because you have to go for the circulars. As I said, I showed you the particular structure. So any PPP project, you have to see, as I said, that first who are the players and what are the various agreements and what are the terms of the agreement. And you have to start with that. So for NHI project, I know there's a concession, mother concession agreement, we call model concession agreement. So model concession agreement, you have to look for it. And then you have to start from there. And then, of course, you have to look for the other agreements, which is the EPC contractors and all you have. So, but most of the cases in HAM, the sponsor itself is a EPC contractor. So that's how you start there.
I can only add that, there are these documents, if you can see, these are documents that were prepared around.
That's, I think, NITI Aayog, right?
NITI Aayog. But this is Erstwhile Planning Commission.
Yeah.
So Erstwhile Planning Commission did a lot of seminal work on preparing the model concession agreements for the PPP frameworks for about 43 sectors. You name an infra project and there is a model concession agreement. Those documents need to be made, I will say, FIDIC compliant. So one of the challenges before the consulting engineering fraternity is to move the entire documentation towards more, balanced risk sharing in the documents for procurement itself. Unfortunately, not much is happening, but we have to educate and use FIDIC. I think that's a series of very good seminars that CEI does. I will encourage our participants to also attend the FIDIC training programs. They will bring a lot of clarity to where the problems are in project financing.
Yeah, I think just to add to Mr. Mathur, there are certain good the projects under the HAM, under the NMCG, Namami Gange projects also, which have been reasonably successful till now in securing some project funding with the private sector also. So that also is a model concessional agreement in the area of water, especially the river rejuvenation. But I think the FIDIC programs can be looked into.
So just to share that, one more question has come. I will just share also that we are coming up with one FIDIC program, which I want to share. That the program which we are going to have it in September. Just share Mr. Tanner. He is a FIDIC accredited trader, and we are having the program in Delhi, which is on 4th and 5th of September, which I will recommend that people should attend. This is model 1, which is the practical use of FIDIC training is there. And apart from this, one more question has come. So I will put it on the screen again, the question. I just paste the question. Oh, sorry. This question I have to copy. Yeah.
Yeah, actually OECF loan, what you got, that is ECA. So that has a different type of loan. That's not a commercial loan as such. So there are loans which comes along with the equipment. So that's a different loan. That's a soft loan. Or also sometimes the government gives a loan. That's a soft loan they can give. But for the green hydrogen, as you said, that's a very, very upcoming project. Now, at this moment, if you want, there you see, getting a soft loan from a commercial agency will not get. You will not get because somebody has to give him that soft money. Then only either government gives. This is one way of giving it. So now in green energy, green hydrogen, if I understand, still we are not that competitive as compared to the normal energy, but we believe by next 3 years. So when the green hydrogen prices come from say up to say $1 per kg, we will be achieving this particular competitive. I'll give an example. When the solar power came, if the price per unit used to be 12 rupees, 13 rupees, 16 rupees. Today, you don't have to give any support. It automatically is 4 rupees. It's much lower than even the coal power. So it will happen in green hydrogen also. But if you ask me who is giving green any soft loan, again, I would say expecting a soft loan from any agency directly without any source. I don't know anybody, any green energy fund has been created. But World Bank and certain other multilaterals have given a line to SBI for rooftop solar. That much I am aware. So where some kind of cheaper loan is possible, because that is again on lending. So what happens, those agencies, they don't want to take the credit risk. So they use some Indian bank to take the credit risk and they just give us cheaper funds. So that is possible. But green hydrogen, as on date, I don't know. I'm not aware any such fund has come to anybody so far. But it may come. It's still in a very initial stage. But also I believe that with next couple of years, you may actually not require any soft loan for green hydrogen. By 2028, 2029, I'm sure green hydrogen will be as competitive as with the other power as such, because that is actually a battery. See, morning time you use solar, you generate that power, convert that into green hydrogen, and nighttime you use it. So basically, it will give a sanctity to the grid, or especially the the grid. Actually be used like a battery. So there'll be some support of it. There is some agencies or some state regulatory corporations, they are trying to structure certain schemes. If it comes, it's also be good.
Yeah, I can only add that this is a very interesting question, and climate funds and this whole issue of sustainable development under the presidency of India, G20, there is this big push to set up a World Solar Bank. And India, as the International Solar Alliance founder, is pushing for a One Sun, One World, One Grid project. It will be a mega grid which will carry only green energy, renewable energy across the world, just like the internet straddles the whole world. We are talking of a power grid from India to Oman, so that we can connect the two continents, and solar energy, other renewable energies can flow, so that there is no need for battery storage. Power can travel all over. These are very, very large, ambitious projects. I'm proud to say that India is leading the way in projects. And the International Solar Alliance is working very actively with the World Bank. Studies have been done, technical feasibility reports are already in place. And maybe in the next decade, we will have an undersea cable connecting India with Oman. And the renewable energy and other energies can flow instead of actually getting the crude oil to travel. I think those are very large financing for which concessional finance will come from under the large G20 framework. Very positive that we will have.
A question from Ram Prasad Yadav.
Yeah, order nuisance for the solid waste. Whether residents are eligible, so that EIA study has to specify if they are eligible, you have to fund it. Now, one way to fund it is because corporations or municipalities can fund it. That's one way. They can give a compensation directly. Or other way is the project can take some kind of return. But actually, waste to energy, it's very difficult to project to take beyond a cost, beyond a certain thing, because otherwise it will become totally unviable as such. So I think it should come from the authority, there's a municipal corporation itself. How to safeguard interest from independent engineer in case of HAM model, wherein concessionaire becomes employer and make payment to the consultant. Yeah, actually, this is a conflict, if you ask me. Basically, this is a conflict. I think what NHAI should do, they should pay you and take money from the authority, because I'll tell you, this conflict was there in the banking also. We used to put lenders engineer and we used to ask the companies to pay it. But now, if State Bank do not do that anymore. So they appoint, they pay them, but they deduct from the company. So this is how I think you should do it. Otherwise, there's a huge conflict on that. I agree with you as such.
That's all the questions we have.
So I think we have to, put the curtains today to the wonderful session, I think. And we will have to follow up with another session with more details. And then I'm hoping that in the next couple of weeks, we will have a physical training. And that training with a workshop-based module could be held in the recent future. So let's move on. Thank you so much to the audience who have been very, very attentive. Thank you, Sri Mathur, for having given your incisive comments. And thank you, Mr. Moitra. Wonderful. I really and personally thank to have acceded and accepted our invitation.
Pleasure.
To speak and share your vast knowledge. And thank you to the CEI at the office at Delhi to have organized this wonderful session. With these few words, we go off the air today and look forward to meeting you again in the next couple of weeks.
Okay, bye-bye.